First session, we're going to kick off with Tom, co-founder and head of research. Uh, Tom doesn't need any introduction, but just quickly speaking, Tom is from Michigan. Tom has been a friend of mine for 30 plus years. He attended Wharton. He was top-ranked wireless analyst for 11 years, starting in the mid-90s. Then he was top-ranked strategist for 8 years thereafter at JP Morgan. He has become a global thought leader in crypto since 2017 when we first launched our digital assets research. Uh, Trust me when I say back in 2017, we had a lot of naysayers and giving us really no credit for picking up a vertical that they thought didn't have legitimacy. Today, Tom is also chairman of Bitminer, the largest Ethereum treasury company. He will be joined by Tom Block. Tom was a lead government liaison for JP Morgan and Jamie Dimon for 30 plus years. Tom currently heads up our policy research today. Both of them will speak about how to capitalize on Wall Street's greatest transformation in a generation. Just a few notes on how the forum is going to work. This forum will run from 11 to 3 p.m. with 4 sessions. Each session will end at the 50-minute mark with a 10-minute break. We will start each session on the hour, so please stay tuned throughout the event. This first session will go to 11:50 and we'll take a 10-minute break, and the second session will be Sean Farrell, head of our digital assets research. There will be a recording of this conference, so if you have to jump, you will be able to see it. Just give us 24 hours. Also, there will be a poll. There's over a couple of thousand attendees. Please participate, and hopefully Tom will review the findings and release the results toward the end of the conference. On behalf of Tom Block, Mark, Sean, and all of my colleagues here, thank you for being part of our family. Thank you for your support. You guys are the reason we love what we do. I'm sure Tom echoes this sentiment. If you have any thoughts and suggestions, please email to us. And I will now turn the mic over to my dear partner, Tom. Thank you very much.
Hey, John, thank you for that intro. And I also just want to echo some of the things he said. You know, we are celebrating our 11th year in operation. It's been a really enjoyable 11 years. I mean, it hasn't felt like a job, actually. And it's really because you guys have been really loyal and supportive of our efforts, and we appreciate that. We do appreciate the retention and the fact that you're listening to our daily videos and following our work. And because, as you know, we're trying to change the way people invest in terms of thinking not only about long term, because I think that's a very common phrase, but we're really trying to get people to think about the super cycles, you know, the things that really matter and drive earnings. So we appreciate all of your support. I've got a presentation, and I'm going to be bringing in Tom Block, who's our head of policy, throughout this presentation. So as a quick overview, the points I want to cover today in the next 40 minutes or so, and I do want to leave a little time for Q&A, is that, you know, the super cycles are intact. So that's why we're not worried. There are walls of worry growing. That's what you're going to hear from folks, and those are going to give you chances to buy stocks. And thirdly, just keep in mind the risk reward's positive. So let's dive into this. You know, I'd say that we still think November is going to be an up month. I mean, with a lot of confidence. And the first reason for that is that stocks are up 6 months in a row, and it's almost going to strengthen the case for November to be positive. But we know it's going to be choppy. We think it's a choppy first 2 weeks, but then we ultimately end up, you know, over 200 points on the S&P. That would take us past 7,000. And these are the 6 years that I think are precedent markets. These are the times where the markets were up May through October. And you can see that the November to December, which is far on the far right, has been positive, except in 1936 when the markets basically were flat. But I think we're in a very different place. That was post depression period. We're really in the middle of an upcycle. And I still think we're going to be at least 7,000 by year end, maybe 7,300. And if you think what's late cycle, just keep in mind that ISM is still below 50, 33 months now. We've never been top of the market when the ISM is below 50. And keep in mind, housing is still undersupplied. We have built only 13.6 million homes in the past 10 years versus 15 million household formations. That's a shortage. That's the opposite of the GFC when you had basically 7.5 million excess homes. And for those who think valuations are extended, keep in mind NVIDIA is trading at only 29 times forward earnings. Costco's at 42.6 and Walmart's 35 times. It's still cheaper to buy NVIDIA than to buy a GDP grower. And in 1998, Cisco was already at 56 times forward earnings before getting to 210 times. So I think we're far from a bubble today. Margins are expanding, and I think it's very telling because earlier this year, you remember the consensus from the Fed was that someone has to pay for these tariffs. So inflation would go up and margins would get squeezed. But in the third quarter of this year, which is in the full force of tariffs, companies taking 67% of that hit, earnings grew faster than revenues. 7 out of 11 sectors had margins expanding. And there's a fund manager chase that's going to happen into year end. So everyone will say, you're going to hear someone tell you, everyone's bullish, Tom. That's not true, because if they were bullish, their performance would be outperforming the S&P this year. And as you can see, 22% of active funds are trailing their benchmark this year. So it's been a bad year for fund managers. And now we have this huge wall of worry. And this is what I think we have to be working our way through. And this is where I'm going to bring in Tom Block into the conversation. But the first is the government shutdown, okay? It is the longest government shutdown in history, 36 days. And Polymarket is now putting the odds that the shutdown ends next week. So I'm going to just sort of bring in Tom Block and ask him to comment on where he thinks things, just to sort of state his current views on the shutdown. I know Tom has some very strong views. And then if he could just talk about the path to ending the shutdown.
Well, thank you, Tom. And let me just join the chorus about how much I enjoy working with Fundstrat. Tom and I met at JP Morgan, and he was incredibly respected. And then when he left, and I had already left a year or two earlier, and he asked me to join Fundstrat, it's just been an honor and a privilege to work with Tom and the great team he and John have built at Fundstrat. On the issue at hand is that the president called the Republicans in the Senate to the White House today, urged them to do away with the filibuster. I just don't think that's going to happen. Before I worked for JP, I actually worked on Capitol Hill, running a congressman's office and a senator's office. And the Senate office, I really appreciated the reason for the filibuster. The filibuster is really the tool that the minority can use to try to influence policy. And the Republicans who are there, and John Thune has been very clear, he does not have the votes to change the filibuster rule. And the reason for that is all the Republicans know that they are not a permanent majority. They will one day be in the minority too, and they will want to use the filibuster to try to influence policies and not just have majority control as you have in the U.S. House. The filibuster has actually been reformed. So prior to 1975, it was a 2/3 or 66 votes to end the filibuster. And then I think largely because of the civil rights movement. They needed to pass legislation that was being bogged down by Southern Democrats. So when I worked in the Senate in the 1970s, there were really three parties. There was the Republicans, there were the Northern Democrats, and the Southern Democrats. And all those Southern Democrats seats have now become Republican seats. And so they really needed to change. So they really got Republicans and Northern Democrats to change the rule in 1975 and make it 60. So I don't think there's much of a chance that they will move it below 60. So they're going to have to find a consensus. I think that consensus is approaching pretty quickly. I think as someone who has worked in government, worked in politics, I think it's just embarrassing. This is a man-made crisis. This is not like Argentina when they can't, when no one will buy their bonds. This is just an artificial, man-made crisis. It's spreading with people like flight controllers who have to have stressful at-work jobs and they aren't being paid, and others who and now the food programs. So they're trying to make up some of the food programs, but there are people who can't feed their children. So this is all, I think, going to come to an end in the next few days. The other thing I will add is the reason they can't do it overnight is that the bill that is before the Senate that the House passed has an end date of November 21st. And that was fine when they passed it 6 weeks ago. But now November 21st is upon us. So people I've talked to this morning in DC are saying that some of the discussion now is what should the new end date be? Should it be Christmas? But there's a growing feeling, I think it should be sometime in January of next year. And that's the discussion I'll be watching in the coming days.
Great. Thanks, Tom. So I'm going to resume the presentation and then bring in Tom in as we work our way through this. The second wall of worry is the Fed's hawkish. And this is where I think the Fed may be misreading some of the incoming data. Now, we know that there's a new Fed chair contemplated, and it's down to 5 candidates. And what I find interesting is that Fed fund futures, okay, the number of cuts in 2026 has not priced in a new Fed because, as I've highlighted in the shaded area red, that in May of this year, Fed fund futures was pricing 2.6 cuts for 2026. And this is at a period when a new Fed chair was talked about. And yet the number of cuts has actually stayed at roughly 2.6. In other words, the bond market has not priced in a dovish Fed. It's actually pricing in the same Fed that has made a hawkish cut in October. And why is the Fed saying December is uncertain? I've highlighted this before. They've talked about the fact that the neutral rate is still being debated. But keep in mind, the neutral rate is dependent on long-term inflation. So the Fed's basically saying, we're not cutting because the neutral rate might be higher because we think there's more inflation. But this is where we're going to diverge our views, because when we look at inflation, 75% of the inflation over the last 5 years came from housing, auto insurance, and new and used cars. And we've talked about this extensively, that look at shelter costs month over month, and Schiller is back to actually below long-term trend. So CPI year over year for OER is going to basically tank in the next few months, falling like a rock. And used car prices fell at the fastest pace in more than 2 years. That's not inflation. And Japanese export prices to the US are tanking. And auto insurance year over year is down to 3%, which is falling like a rock. And there's some repo market stress, but that's going to get fixed when the shutdown ends. And then it's really the mayoral race in New York City. And keep in mind,